for some insights and stats on the markets. Let's bring in Ryan Detrick, Chief Market Strategist at Carson Group. Ryan, good to see you.
Good to be here. Always enjoy your fine city.
Yes, and glad to have you, along with the masses that come this time of year.
It's crowded out there.
So if we were to get to a new high in the S&P by the end of the year, we're talking about 8.5 trading sessions until we're done.
We're close.
It's like a 3% move. So, I mean, what gives you confidence, if not that we get all the way there, that things still should get a lift?
Yeah, I want to talk about yesterday for a second.
Sure.
So you see the headlines, down a lot, tech down a lot. There were more 52-week highs on the NYSE yesterday than there were the day before. The number of stocks on the S&P 500 above their 50-day and 200-day actually increased yesterday. Yeah, we can go through more of them. I mean, the reality is we all complain only 7 stocks going up. Mike, we are seeing more of this broadening out, and I get it. Tech is such a big part of it. Last comment, you look at advanced decline lines. They're still pretty solid. And one more for yesterday. I think if there's a mantra under the bed with Oracle and tech and AI, we'd see it in the high-yield corporate bonds. High-yield corporate bonds are barely down yesterday. They're less than 1% from all-time highs. This volatility is legit, but I don't think it's like the first domino to fall for everything to fall apart here.
Yeah, I mean, you're seeing it, I guess, with specific credits like Oracle's, but not maybe bleeding over into the broader credit picture. I take your point that there has been, this is what a broadening might look like, which is a stalled index. Yeah. And by, say, stalled, the S&P 500 closed yesterday at levels of 2 months ago, basically, from before last third quarter earnings season started. And yet you have seen traction in parts of the market like banks and some cyclical stocks, transports, even energy gets a bounce. Is that the formula we're looking for next year, or do you think it can be a different story, or can kind of tech reassert leadership?
No, we think it's probably more this broadening out. You mentioned tech. If I were along with you a week ago, we'd be saying tech's up 13 days in a row, the longest win streak ever. And now it's having one of its largest 5-day losing streaks, since April, I guess. So really, tech is where it was 3 months ago. So we're not minimizing it, but I think it is this broadening out. And I know I've come on with you guys for a while saying, and I'm sure other guests have too, look around the globe. I mean, there is a lot of strength around the globe. Yes, we like the U.S., we're overweight U.S., but we still like developed international. Big question a lot of portfolio managers have, is developed international going to keep outperforming next year, or just a one-year blip like we've seen for the past 20 years, is one-year blips? We think, hate to say this time is different, 4 most dangerous words. We do think this broadening out global theme, Mike, is legit as we reaccelerate the global economy next year.
We've had, it's interesting, sometimes you get the consensus for the year ahead, like last year, where it was like, this is the year for equal weight over the market cap weight. I'm not sure you had people confident about the global trade, but it's really worked this year. And so maybe a year later, that starts to come together, right? I mean, do you actually think that that we can get positive returns if the Mag 7 is not really outperforming?
No, we think we can, and I think one of the big things everyone's going to be talking about midterm year. Midterm year is the worst year of the 4-year cycle, down 17.5% peak to trough. All that stuff is out there, but if you don't have a recession, and that's our base case, the S&P 500 is up 10% or more for the year, 70% of the time. Yes, we're going to have 3 strong years going into next year, but one of the things we've talked about, this is still a young bull market. It's just entered its 4th year. Last 50 years, and you've had a bull market at this point, been 5 of them. The average has been 8 years. The shortest has been 5. So those are just some numbers, but to think this bull market's old is not true. Then you look at something like Germany. Germany just earlier this year broke out above levels from 2007. So there are some parts of this market, and transports. I mean, my goodness, transports just broke out last week for the first time, in several years. So there's some parts that are probably going to keep taking this baton, and we like that.